Hello viewers, welcome to my channel. I'm Hasham. So far 13 problems I have completed on valuation of shares. Now in this video 14, 15, 16, 17, 18, 5 problems I'm going to explain in this video. So if you want the perfect command, watch all the videos from beginning till end, don't skip in between. Apart from this advanced accounting, I have uploaded so many subjects videos like financial accounting, cost accounting, management accounting, corporate accounting, computerized accounting, and apart from that, business statistics, income tax, and even financial management, investment management, statistics for management, operation research. So many subjects videos I have already uploaded in the playlist. So if you want any of the subjects videos, you visit the playlist, select your subject, watch the video, be perfect about the concept. In detail, I have explained each and every concept of every subject. Now, before starting the 14th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always take a hard copy printout ready before watching the video and take the screenshot of the points which I have written on the board. Then I'll explain every point in detail. Now, see the 14th problem. Problem number 14. From the following information, calculate the value of each equity share. 2010% preference shares of 100 each, 2 lakh. 50,000 equity share of rupees 10 each, rupees 8 per share paid up, 4 lakh. Expected profits per year before tax 3 lakh. Rate of tax 50%. Transfer to general reserve every year 20% of the profits, and normal rate of earnings is 15%. It is not specified which method we have to adopt, but according to the information given in the problem, we conclude that we have to apply yield method because profits are given. The assets, liabilities are not given. That's why we cannot find out the intrinsic value. We have to apply yield method, right? Now here expected profit before tax is given. We don't require before tax. We need how much is the profit available for equity shareholders after making all appropriations. So first take the profit before tax. From that profit deduct the tax. Tax is 50%. So 3 lakh rupees is the profit before tax. 50% means 1,50,000 is the tax. Deduct the tax. Remaining 1,50,000 profit after tax. But every year 20% of profit is transferred to general reserve. Of that 1,50,000, 20%, 30,000 will transfer to general reserve. Then from the remaining amount, first we have to pay the dividend to preference shareholders. So we deduct the dividend to preference shareholders, remaining profit is available for equity shareholders. Now you can see carefully here, expected profit before tax 3 lakh. Given. From that 50% tax, 1,50,000 tax. Profit after tax 1,50,000. Every year it is given in the problem. 20% is transferred to reserve. If it is given, we will take. So here 20% of 1,50,000, 30,000. Deduct 30,000, 1,20,000. From 1,20,000, now we have to pay the dividend. But according to company law, first of all, dividend should be paid to preference shareholders. After paying the dividend to preference shareholders, the remaining profit is available for equity shareholders. So minus preference dividend. In the problem it is given the rate of dividend on preference shares 10% of 2 lakh, 20,000. Deduct 20,000. So 1 lakh rupees is the profit available for equity shareholders. Now the formula for yield value of share is expected rate of return divided by normal rate of return into paid up value per share. Already in so many problems we have applied this formula. So normal rate of return will be given in the problem. Paid up value per share will be given in the problem. But expected rate of return is not given. We have to find out. So here expected rate of return ERR. profit available for equity shareholders divided by equity share capital into 100. So here profit available 1 lakh, and in the problem you can see equity share capital is 4 lakh rupees. Divide by 4 lakh into 100, 25% ERR. That's it. Now we substitute in the formula yield value of each equity share is equal to expected rate of return divided by normal rate of return into paid up value per share. The expected rate of return 25%, normal rate of return given in the last line of the problem 15%. So 25 by 15 into the paid up value of each equity share is 8 rupees. Actually face value of the share is 10 rupees. But the company has called and paid up amount is 8 rupees. Multiply by 8. So you will get 13.33 rupees. 13.33 is the yield value per share. That's it. Now we'll come to the next problem, that is problem number 15. Now see carefully. R. Diwakar holds 5,000 equity shares in Hindustan Limited, the paid up capital of which is 30,000 equity share of 1 each. So in the company, the total share capital is 30,000 share of rupee 1 each. And the investor is Diwakar. He is holding 5,000 shares. It is ascertained that the normal annual net profit of the company is 5,000 and the normal return for the type of business carried out by the company is 8% NRR. Sri Diwakar required you to value his shareholdings based upon the above figures. Now, first of all, we cannot find out the intrinsic value because assets and liabilities are not given. Here we are given the profit. So we have to apply yield method to calculate the value of share. So for yield value, we need ERR, NRR and paid up value. Normal rate of return is given in the problem 8% and the paid up value per share is given 1 rupee. But the thing is ERR, expected rate of return, is not given. So how to find out net profit divided by equity capital into 100? The net profit is given in the problem 5,000 and the total equity capital of the company is 30,000. 30,000 into 1 rupee, 30,000. So 5,000 divided by 30,000 into 100, you will get ERR. See here. 5,000 by 30,000 into 100, 16.67 is the ERR, expected rate of return. Now yield value, ERR 16.67 divided by NRR 8% given in the problem into paid up value per share is 1 rupee. So you will get 2.08 is the yield value per share of Hindustan Limited. That's it. Now 16th one. From the following information, calculate the value of equity share. The paid up share capital of the company consisted of 1,015% preference share of 100 each and 20,000 equity share of 10 each. So we have preference capital and equity capital. The average annual profit of the company after providing for depreciation and taxation amounted to 75,000. So this is the profit after tax. It is considered necessary to transfer 10,000 to general reserve before declaring any dividend. So it is custom in the company that every year 10,000 rupees will be transferred to general reserve before declaring any dividend to shareholders. So from 75,000 we deduct 10,000, so 65,000. Now from 65,000 first we pay the preference dividend. Then the remaining profit is available for equity shareholders. The normal return expected by investors on equity share from the type of business carried on by the company is 10% NRR. So the problem is very simple. We have to apply yield method to calculate the value of share. The average annual profit is 75,000. It is given every year 10,000 rupees should be transferred to reserve. So I am deducting 10,000. 65. From 65,000, pay the preference dividend. It is 15% of 1 lakh. It is given. The rate of preference dividend is 15% and the total preference capital is 1 lakh. So 15% of 1 lakh, 15,000. Deduct 15,000. So 50,000 is the profit available for equity shareholders. Now expected rate of return. Profit available divided by equity share capital into 100. Equity share capital is given 2 lakh. So 50,000 divided by 2 lakh into 100, 25% ERR. Now simply you substitute yield value of each equity share is equal to ERR divided by NRR into paid up value per share. NRR is given in the problem 10% and the paid up value per share is 10 rupees. So this 10 gets cancelled. So 25 rupees is the yield value of each equity share. That's it. Next, 17th problem. See the 17th one. Compute the value of equity share of each of the companies A and B on the basis of the following information. So we have to find out the value of each equity share for A company, B company. Profit after tax 1 lakh, 1 lakh. 10% preference share capital shares of 100 each, 1 lakh and 2 lakh. Then equity share capital shares of rupees 10 each, 5 lakh and 4 lakh. The normal rate of earnings is 15%. NRR is 15%. Very simple. Again, we have to apply the yield method because profits are given. So in a tabular form, I am going to solve the problem. So A limited, B limited. Profit after tax is given in the problem 1 lakh, 1 lakh. Less preference dividend. From profit after tax, first we have to pay the preference dividend. In the first company, 1 lakh rupees preference share capital, A company. In B company, 2 lakh rupees is the preference share capital. The rate of preference dividend 10%. So 10% of 1 lakh, 10,000, 10% of 2 lakh, 20,000. Subtract. Then 90,000, 80,000. This is the profit available for equity shareholders. Now ERR, expected rate of return. Already almost every problem we have applied. Profit available divided by equity share capital into 100. So profit available 90,000, equity share capital 5 lakh given in the problem A company into 100. 18% is the ERR for A company. For B company, profit available 80,000 and equity share capital given in the problem 4 lakh. 80,000 by 4 lakh into 20%. We got ERR, we have NRR, we have paid up value per share. Substitute yield value. ERR divided by NRR into paid up value per share. ERR 18%. NRR given in the last line of the problem 15%. So 18 divided by 15 into paid up value per share is 10 rupees. So multiplied by 10. 18 by 15 into 10, 12 rupees is the yield value of A company. For B company, 20% is the ERR and NRR is 15%. Paid up value 10 rupees. 13.33 is the yield value of shares of company B. That's it. 17th problem completed. Now 18th problem. See carefully the 18th problem. On the basis of the following information, calculate the value of equity share amount. 5,006% preference shares of rupees 100 each fully paid 5 lakh. 30,000 equity share of rupees 10 each fully paid 3 lakh. Total tangible assets other than goodwill is 9,49,000. Total outside liabilities 95,000. Average net profit of the company after payment of tax 57,000. Expected normal yield for equity shares 7% of capital employed. Goodwill is to be taken at 5 years purchase of super profit if any. So little bit difficult, little bit twisting problem. Here we have to apply intrinsic value because assets and liabilities are given, right? Normal rate of return is not given. So we cannot find out yield value. We have to find out the intrinsic value. But before finding out the intrinsic value, we need to calculate the value of goodwill. It is given 5 times of super profit. In the previous videos, I have explained you about valuation of goodwill. One of the method of valuation of goodwill is super profit method. Calculate super profit into number of years of purchase. It is given 5 times. So what is super profit? FMP minus NP. Future maintainable profit minus normal profit. You will get SP, super profit. So first we need normal profit. We need goodwill. So here I am writing calculation of the valuation of goodwill. Total tangible asset other than goodwill 9,49,000 given in the problem, right? Less outside liabilities, the outside liability 95,000. So total capital employed is 8,54,000. But we need to calculate the return on equity shares. So we don't require total capital employed. We need equity capital employed. Equity capital employed. So from the total capital employed, deduct the preference share capital 5 lakh. So equity capital employed is 3,54,000, right? Now normal profit is equal to equity capital employed into normal yield on equity capital employed. In the problem 7% is there. Expected normal yield for equity shares 7% of capital employed. So this 7% is not on the total capital employed. This 7% on the equity capital employed, right? So equity capital employed 3,54,000 into 7%, 24,780 is the normal profit. Now future maintainable profit is the past average profit adjusted for any changes, if any, in future. But in our problem, we are not given any changes in future. So whatever is the past average profit, that itself will be the FMP. So what is the average profit given? The average net profit of the company after payment of tax, 57,000. So we can treat the 57,000 as the FMP, future maintainable profit. But 57,000 is the average profit. But we need the profit available for equity shareholders. So from the average profit, subtract preference dividend. The preference dividend is 6% of 5,30,000. So deduct 57,000 minus 37, 27,000 is the profit available for equity shareholders. And this is the FMP. FMP of equity shareholders is 27,000. Super profit, I told you, FMP minus NP. That means 27,000 minus 24,780. You will get 2,220. That is the super profit, SP. Now goodwill is 5 times of super profit given that in the problem. We have to multiply by 5. So super profit 2,220 into 5. You will get 11,100 as the value of goodwill. Now we proceed to find out the intrinsic value of share. So see carefully, calculation of intrinsic value. Total tangible assets other than goodwill. Leaving the goodwill, what are the total tangible assets? 9,49,000 given in the problem. Same 9,49,000. Now goodwill will also be included for calculating intrinsic value of share. We have to include goodwill. So what is the value of the goodwill? 11,100. So add up 11,100, 9,60,100. From that subtract outside liabilities. Outside liability 95,000. So 8,65,100. From this subtract the preference share capital. We will get the amount available for equity shareholders. The preference share capital 5 lakh. So we get 3,65,100 and this is the amount available for equity shareholders. Number of equity shares given in the problem 30,000 total number of shares. And we know the intrinsic value formula. Intrinsic value is equal to amount available for equity shareholders divided by number of equity shares. So amount available is 3,65,100 divided by 30,000. You will get rupees 12.17. This is the intrinsic value of equity share. So in this video, I have explained you 5 problems. So if you're watching all my videos, if you are following my instructions, definitely you will get a lot of confidence on this topic of valuation of shares. Always keep a notebook, calculator, pen ready while watching my videos. Simply listening the lecture, watching the video will not be sufficient. If you want the complete knowledge, you must maintain running notes. Every now and then some important points I will explain which are not written on the board, but I am explaining. So always keep a running note. then only you can be able to get a lot of confidence on the subject. So we have completed 18th problem. Inshallah, we will continue the next 19th problem in the next video. So if you are satisfied, give a like to the video, share my channel, give your comments, subscribe my channel if you are not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue the next problem in the next video.